Hello, 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 hello. Okay, so it's 1:37 p.m. And hello, 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 hello. Hello, 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 hello. Let's stop audio too. Hello, 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 hello. ನನಗೇನೋ ಕರೆಕ್ಟಾಗಿ ಕೇಳಿಸ್ತಾ ಉಂಟು. Stop audio. Early 50. Microphone. Okay. Right right now 1:42 p.m. in Indian Standard Time. Hello. Okay, it's perfect. Plus of 40. Okay. Okay. So how do these financial instruments or financial markets work? So to understand this, we have to understand what are all these things. Okay, there is quite a hint is clear. Okay, so imagine there is a fruit. Okay, so ठीक है. This is a fruit. What is this fruit? Let's say uh, let's say this is a mango or green apple. Okay, so this is a green apple, and you have this with you. Okay, but you don't want it anymore, and now you want to sell it. Okay, so you want to sell this particular thing for some money, and you are looking for someone who is going to buy this thing from you. Okay, so here's a buyer. Let's say, okay, so this person is B. Okay, this is a B person, and you are this person. Okay, so you are this person. So he wants to buy your particular apple, or it may be anything. He just wants to buy an apple, or else a green apple. What do you have? Now you have this apple. Okay. Okay, you have this apple with you. Okay, तुम्हारे पास ये apple है. हाँ. And now you want to sell it to someone who is willing to buy this thing. Okay. So what you are going to do is you go to the market, local market jo hai. You go to the local market and check what is the price of this particular apple right now. What is the current price of that particular apple? What you will see is, okay, it's around 10 rupees, or I'll say, let's consider it as the price of this particular apple in the market is $10. Okay, so if you want, but you have bought this apple at the price of $9 in your nearest shop. Okay, so if you go to this person who has also been in the market, who has also been to the local markets and all those things, he is willing to buy this thing at $10. Okay, but now what you want to do is you want to sell this apple to this guy. Okay, so what do? You go to this person and say, okay, here I'll give you my apple for $10. Okay, so now what this person does is he grabs out his $10. Let's say this is his wallet, and he grabs out $10, $10, and then he gives that money to you. Okay, let's say this as a note. Okay, he transfers this person B. He gives you that money, $10. Okay, now what you're worth? Now you have $10 in your account. This is the basic market understanding. This is how the market works, right? So what happened here? We had a nice trade. You had the apple, you sold the apple to the person. What you had, you gave your apple to him at the cost of $10. Okay, and then he gave his money back to you. Not back. He gave his money to you. Okay, so it's money, and here is you gave him the instrument. Okay, so this is the basic structure of how these markets work. Okay, so what is this price? This was the bid price. Sorry, this was the bid price, and this was the ask price. Because since we are sellers, we are going to ask the money. We're going to ask the money from this particular thing. This person who is going to bid some money. Okay, I'm going to buy this thing at $10. So let's imagine if this person is willing to buy this particular thing. He says to you, apart from $10, he says to you, I'm going to buy it at $9.10. Okay, so now what you're going to do is, no, I'm not going to give you that apple, because in the market it is being sold at $10. Okay, so why should I sell this person for a 90 cents loss? Okay, if we validate this transaction, we would have lost 90 cents. Okay, we would have lost 90 cents. So we don't want this. So in order for us to gain the profit, what we are going to do, we are going to look a particular person who is going to buy this thing. Okay, that is called as the order book. What do you see in? Okay, here you can see this particular thing. You can see what is being happening here. A person is ready to sell this thing. Okay, sorry. A person is ready to buy this thing at 2736.010, and a person is trying to sell this thing at 2736.890. So the difference between, okay. So here, the person is bidding for $9.10. Now we are asking him to pay a price of $10. So what is the difference? So the difference here is 0.90, and this is called as spread. What is a spread? Spread is a difference between the bid price and the ask price. Okay, we need to keep this in mind because we are going to deal with this the whole time. Okay, sorry. Okay, so uh, let's say this person finally agreed to buy this thing uh, at $10. Okay, so he bought this thing at $10. Okay, so when we are continuously arguing, and when he says $10, I'm going to sell my apple to him and take his money. That is the rapid reaction and how the trades actually execute in the market. Okay, so I sold my apple to him, which means I am the seller and he is the buyer. Okay, so what did I get? I got my $10 and he got his apple. Okay, so a buyer and a seller makes up a volume. Okay, so this is one volume, because what was the instrument traded? How much instrument were traded in that particular time frame? Let's say 1 minute. We argued for 1 minute and we finally agree upon a price which was $10. Okay, so I sold that particular thing which is at a particular minute, so that is a one volume. Okay, so this is how the financial instruments work. So all the things that you see right here is all these candles that you see right here. These are the volumes of those particular instruments. Okay, So as you can see, it's saying 157. Look at here. Check this field. Okay, so it's 157k, 71k, 63k, everything. So this is how the trades are actually executed in the market. Okay, so what do what do we learn from this is there are so if you open the market randomly at any particular time, you will see a chart. Okay, you will see a chart and a volume chart. Okay, so this is the volume chart and this is the actual chart. Just something like this. What does this indicate is where are the most trades getting executed? Oh, sorry. How many trades are executed at a particular price? Okay. How many instruments were traded? How many instruments were traded at this particular price, this particular price, this particular price? It all indicates that. Okay, so what do we learn from this is why this is important is because, say, if the price is moving in an upward in an uptrend, okay, price is continuously moving higher and higher with the time, and the volume of that particular thing is also increasing. What does this indicate? People are buying more, more, and more, and more. So let's imagine this was $10, this was 20, this was 30, and so on. Okay. So when let's say this was uh, let's say this was 31st of October, this was 1st of November, and this is 2nd of November, which is today. है ना? Sorry. And let's say this is the 3rd of November. This is the 3rd of November. Okay. So when the price was in 31st October, the price was $10, and now the price has doubled to 20. Okay. But the amount of people those who are buying this thing here are considerably more at sorry the people who are trying to buy this thing, let's say this is also an apple. Okay, the people who are trying to buy this particular apple, the same apple, for $10. Okay, for $10 these particular people were buying this thing on 31st of October. So on 1st of November, what happens is there is some news or some fundamentals or something happens, and then the price suddenly goes up, and now people are ready to buy this same apple, which was $10 a day ago, now for $20. And the same apple on 20 on November on November 2, okay, people are ready to buy the same apple which was $10 on 31st October and $1 and $20 at 1st November. Now they are ready to buy this thing at $30, which is three times the price. So don't call these people as stupid. Okay, these people are not stupid. This is called something as a demand of that particular apple. This apple must be must have some specific. Uh, this apple must have some speciality towards it that it is attracting more and more people to buy itself. Okay, so actually the apple is not special. Actually, the people are not dumb. It is the demand of that particular apple is increasing with time. Okay, so what is the data we are getting here? Okay, if the volume of some particular thing is increasing with the time, with the price, then that is called as an uptrend. That we should keep in mind. Same goes vice versa for the downside. Okay, prices consecutively crashing and moving downwards, and in the same amount, if the volume is also increasing, then what it indicates that people are not interested to buy this thing, people are only interested to sell this thing, which means it is in a downtrend. So let us see the examples for that. Let's hop on to 1 day chart. So this is a gold chart. Okay, so the gold was continuously falling down. Okay, it was crashing, and as a result, you can see over here, volume is increasing with time, which indicates that more number of people are not interested in buying the gold. They are only interested in selling this thing. As a result, what happened? The price eventually came all the way towards the bottom. Okay, which is nearly around $1,000. Let's imagine this. Okay, so after that, the gold prices started to improve a bit, and at this particular time, what happened? The COVID occurred, and all the people, all the institutions started to invest in gold. As a result, price started to bounce back. Okay, so here also you can see this is the volume. These are the huge volumes, which represents if there are more number of volume. Okay, if there is more number of volume, then there are more number of people trading at that particular time frame. Okay, that we need to remember. So what is happening here? The gold price is increasing as the volume is increasing. Okay, as a result, price went from here to here. Then it started to crash. Then it started to take some pullbacks and all of those things. Okay, people started to book profit, and at the late 2023. Okay, check out the volume. How is the volume behaving? Earlier we were here, volume was flat, and then slowly volume started to increase. More number of people started to trade in gold as the price was pushing higher and higher and higher. Okay, why this led to the increase in the price dramatically. Okay, so this is the significance of volume. Why we need this data is because to find out the area where huge traffic is. Okay, let's imagine this is a supply zone. Supply means where are the most active sellers, and this is a valid demand zone. Okay, you might see more number of volumes. Okay, let's imagine the price was something like this. Okay, price was something like this. You will see more number of volumes at this area and this area and this area, this area and this area. Why not here? Because more number of participants are buying this at cheap and selling this thing at a very high price. Again, buying cheap and selling high. Why? Because if there exists a particular supply, there has to exist a particular demand zone. Okay, so when the people are going to buy this thing, let's say the price is currently here. Okay, it is at $2,900. Okay, so if I am an active buyer, if I want to gain some profit, why do people trade in the financial markets? Is to gain profit. Simple. Yaar. You might go to any field in the whole entire world. What you want is you just want money. You want your profit, right? So when is the see this trading, these charts and all, these are just the probabilities. Okay, so if I want to earn some money, if I want to make some profit, I have to buy this thing at a very low price and sell it at a very high price. So what people do is people will wait for the price to enter some discount level. Okay, which is at 2870. Let's imagine this as our demand zone. What people start to say is price will slowly start to reverse from here, indicating that price is now price has now created a demand. Okay, because more number of people are interested to buy this thing at 2870. Okay, so more number of people are interested to buy 2870. Why? Because they know that gold price will eventually grow with the time, because it is a commodity. It is the most demanded commodity in the entire world. Okay, so uh, when it reaches 2940, what people are going to do? The people who have bought at this particular zone will sell this particular thing, eventually bringing the price even further downwards. Okay. Now price has created a demand for suppliers, for the supply. In short, people are selling this thing over here because now it is over expensive. Okay. Now it has grown now it has grown a lot. So people are trying to sell this thing at a particular zone, which is 2940. Yeah. So what was the difference? How much profit did we earn? Around 30, 40. We earned about a $70. But this was a high probability trade. Why? Because we bought at a lower price and sold at a higher price. But what would it happen if we had bought somewhere around here? Okay. So if I wanted the same $70 profit, I would have to buy this thing. I would have to wait for the price to reach somewhere around here. Okay, somewhere around here. But I don't want that. So in order to avoid these particular losses, because in the middle of the zone is very crucial for the retail traders or anyone. It may be anyone. Okay, so if you are trying to buy in such areas, the chances or the probability of you having a profit is comparatively low. Because what did you see? When the price hit a particular supply zone, which is at 2940, the price started to crash. Okay, you have entered over here. Price went all the way to this zone, and now the prices are turning back towards the demand zone. Okay, so this was the concept of supply and demand. This is I'm just giving the overview of how this forex market works, because this is how we trade. Okay, so what you should look for in the charts. Okay, so the number one thing is these things. These are the key indicators. These are the backbone of every single financial instrument. How much, what, and how much, and how many people are interested to buy this particular financial instrument at that particular time, at that particular price, at that particular rate. Okay, rate means speed. Okay, if suddenly the volume prices start to pump, okay, that means that big players have entered the market. These are the big daddies. Okay, big daddies refers to 100 million, a billion, 10 million, maybe any number of money. Because to push the price from here to here, it requires a hell amount of money. It would take a minimum of 10 to 100 million dollars. Okay, 10 to 100 million. You would easily require all of these things, all such money. Okay, so how to actually identify these particular points that we can buy that particular thing at the lowest price and sell that particular thing at the highest price. So what we should look for in the market is the at what time frame we are looking at the market. So in the 1 day time frame, okay, these candles represent a whole day of which the financial instrument was traded. So as you can see in the upward area, this is open, this is high, this is low, and this is close. What price did we open at? What was the highest price at that particular day? What was the lowest price at that particular day of the gold? And what was the closing price? Okay, what price did we close? Okay, what are the so let's now learn how these things actually work, how these charts actually work. Okay, so we have right now here a supply area. Okay, let's consider this as a supply area and this as our demand area. This is as a demand zone. Okay, now the price has suddenly crashed. Now it is trying to recover a bit. So, okay, that is our supply area. We'll mark it as a red. So this is our demand area. Okay, this is a demand and that is a supply. Supply means where are more number of sellers. Demand refers to where are more number of buyers. Okay, so let's imagine the price is somewhere around here. Okay, price is somewhere around here. What it indicates that, okay, let me mark down the 50% level. Okay, so here price is, this is the 100%, this is the topmost price, this is the 50% level, and this is the 0% level. Okay, so what does these tell is, uh, let us draw a buyer to seller equilibrium. Okay, this is the buyer. Okay, this is the equilibrium line. These are the buyers and these are the sellers. Okay, so let's imagine price is somewhere around here right now. So what does this indicate? Price is been consecutively falling. Okay, it fell a bit and it is pulled back and it is now falling. Does it come under this 50% level? Yes, it does. What does this mean? That there are more number of sellers and less number of buyers. Okay. Okay, this is the, okay. यहाँ पे ज़्यादा होते हैं, यहाँ पे कम होते हैं. Let's imagine that. Okay. So when price is here, people are not interested to buy this thing. People are only interested to sell this thing. Now what happens? Price start to consolidate. Consolidate means there are some number of buyers and there are some number of sellers. Okay. So now what happens is price eventually crashes a lot and hits this button. Okay. Price eventually comes down to here. Okay. Now what happened? There are less number of buyers and there are more number of sellers. But what happens suddenly is, okay, when the price starts to hit this particular thing and then it starts to pull back a little bit. So what happens now? There are more number of buyers and few numbers of sellers. Why? Because the price is trading at a particular demand zone. Let's name this. So now the price is in a demand zone. What is demand or a support zone or whatever you may call it? So here all the buyers are executing their trades. All the buyers are executing their trades. Okay, so their trades might be something like this. They're going to enter here, they are going to keep this stop loss over here, they are going to target this particular zone or this particular zone, this. They might be targeting any single thing, but that's not important for us. What is important for us is where these people are entering and where their stop losses are. Okay, so if price, let's imagine I looked it up on the chart on the, let's say it's Monday and I open the chart and I see this. Okay, now what happens is, now what I'm going to do is, if the price came down back to here, I'm going to buy this thing. Okay, I'm going to buy this thing at 2860. Okay, I'm going to buy this thing at 2860. The maximum amount of risk I'm taking is $10. If the gold reaches 2850, okay, $2,850, then I'm going to exit this trade with a $10 loss. Okay, so this becomes my target and this becomes my entry and this becomes my stop loss. This is the most important thing for any financial market to work. Okay, these are the areas where big players enter this market. Okay, so what happens here is there are significantly more number of buyers and very minor number of sellers, because nobody wants to sell this particular thing at a very premium price. Okay, everybody wants to sell or buy those particular things at a discount price. So if the people also think like me and they saw a support zone and all of those things happen, then all of the people who are trying who are executing the trades will be buyers because they see a demand zone, right? So all the people start to buy this thing at 2860 with me. Okay, let's imagine uh, there are 100k trades executing right here. 100k trades, which can be nearly 10 million. Let's say $1 million. $1 million worth of uh, gold is bought here by different people. Okay, so total of 100k trades have been executed. So what happens now is price start to increase. Okay, the gold's demand start to increase. What happens now? There are quite a number of sellers, but there are more number of buyers. As the demand is increasing, the sellers are decreasing. Okay, so what it essentially leads is, it leads the price to go up. Okay, so now it is at my target zone. So what the people will do, the people will start to think, okay, yes, this is the price where the price took the previous resistance, and now they are going to sell this particular thing. Okay, they are starting to book their profits. How much is the price right now? It is $14, which is around $64 of profit for me. I got it at 2860, $40 over here, and another $14 over here. So I am at currently at $64 of profit. Okay, so I'm at $64 of profit. And and what I'm going to do is, I'm going to start to sell all of my things. So now the 100k trades are executed at this particular zone. So what is happening right now? There are more number of sellers, there are equal number of sellers and equal number of buyers right now, because people who have bought this particular gold here, they are trying to sell this thing because they want profit. Okay, so when this particular thing occurs, what happens is, eventually all the people will start to sell this thing at a particular time. Okay, so now what happened is, there are more number of sellers and quite a few number of buyers. Although market is in an uptrend, because it has broken this thing, it has reacted to a demand zone, but the price is retracing back. The price is retracing its path back towards the demand zone, because the price is not going any further and people are not interested to buy this thing at this particular price, which is 2912 or 2914, whatever, 2915. Okay, so people are ready to buy this thing right here. Okay, so now what happens is, the price starts to pull back. Pull back refers to something or the profit booking that led to a break of structure and returning back to that zone. Okay, so if I am smart, I have seen, let's say, okay, what was the date? On 1st of November, the price was 2860, and on 1st of November, 11:30 p.m., the price was 2910. So, if the price comes back towards this zone, okay, so we are not going to know when the price will pull, when the price will go up, will reverse. It may be like this, it may be like this, it may be like this also, it can be like this too, and it can be this, and it can be eventually this too. But we are not going to know what are what is that particular zone at which the gold prices will reverse. Right? Nobody knows. Nobody can predict the market. Nobody controls this thing, because this particular market or this particular instrument is traded differently at different time zones by different people with different opinions. So I'm going to wait for the price to reach my discount level. What is a discount level? I've marked this thing over here. Okay, so I'm going to take my particular 0 to 100% level and mark out where the price was previously. Okay, and mark out the lows and mark out the highs. Okay, so this becomes my premium zone, the zone below this 50%. Since we are buying, we are trying to find this thing between 0 to 50%. That is our premium level. How can I refine it more? By looking at where the price was pausing. Okay, okay, so I am seeing a pause over here, and suddenly some sellers were trying to sell this thing, but the price reversed and took all those buyers stop losses. Okay, so I would see this as a perfect zone to enter the market. Okay, so now what the price does is, price eventually tries to pull back into the zone. And once the price hits this particular level, which is around 2870. Okay, earlier the price was 2850. Okay, so now the people are trying to so now what I'm gonna say is some retail investors are trying to buy this thing at 2870 itself rather than waiting till 2850, since they are in a fear of missing out that the price will eventually start to move without hitting this particular 2850 zone, $2,850. The price starts to reverse here itself, indicating that now people are trying to buy this in a premium amount, because since they have saw since they have seen the price jump from here to here around $60, 50 to 55 to $60. What will people think? Okay, let the price to come back till this level, and I'm going to buy this thing at here. So the people will think like this, and price again what it does is it uh, it follows its path towards the zone, and no more sellers are interested to sell this thing, because the people who have bought here now are not trying to exit this particular thing at $35. They want a minimum of $70 to $60, right? So what happens is nobody sells over here, and all the buyers are ready to sell this thing here. Okay, so this is another resistance zone. This might be the previous data or something like this. Okay, so what happens right now is people who have executed their longs. Okay, people who have bought down this thing at here, they will start to sell this thing at this particular supply area. Okay, this is an intermediate supply area which is at a 50% from this particular zone. Okay, if I mark down the top to bottom. Okay, so as you can see, this is a 50% level. Okay, where most of the sellers are sitting and they are trying to execute their trades. So what happens is when these people start to book their profits, yeah, the retail sellers or the new number of sellers who are trying to enter in the market, they will see an opportunity that these people are selling, so let's sell with them, eventually leading the price towards the another demand zone. So as a result, people see this as a premium price. So this as a discount price, this as a demand zone, and people will buy more. And eventually, the pullback will be over, and all the sellers who have executed their sell orders. So, the way the buy orders are same for the vice versa sell orders also work. And the people who have sold this thing at particular this point, and at this particular point, they start to exit their trades, eventually uh, pushing the price more higher, and new number of buyers new number of buyers will will enter the market. Okay, now this thing makes a new high, and no more number of sellers or no number of people are exiting their trades, and in this way markets move. Okay, so price was this, and all the volume spikes here. All the volume spikes you will get here is, so okay, the price the volume might be like this, and suddenly at this particular point the volume will rise, and then slowly the volume will be down, and then the volume will rise up again, and then again something like this. You'll see something like this in the volume chart. So this is how actually this financial, it might be any financial instrument, if it has a chart and if it follows technical, then okay sir, so if that particular price follows something, so this is the basic blueprint of how the market works. Okay, so what do we learn from this is, where are what were the things, what were the key takeaway from this were, we have to sell this thing at the premium zone with the people who are trying to exit their trades and who are booking their profits. Okay, so this particular red line indicates as a pullback zone. What is a pullback? Pullback is a profit booking plus midterm selling. Okay, So the people who have longed over here, they are trying to book their profits, and people who are trying to short over here, they are trying to trade this particular pullback. Okay, if the price has broken the structure, this is called something called as a change of character, where the price breaks this particular previous supply zone and pierces through that particular zone. In this way, the market works in an uptrend. Okay, so what do we call this area? This area as a break of structure. Okay, this area as a break of structure. So let's imagine the price starts to go back a little bit, but it failed to break this area, and eventually what it is, it break the low. Okay, so what do we call this? This as a change of character. Change of character occurs when the structure, when the price forms a structure, but it fails to do its job. Okay, so what is the job? What is the job of this particular low? This particular low, the job of this particular low is to make this particular high, because in order for this to be considered as a strong high, there are two abbreviations for this: strong highs and weak highs, and strong lows and weak lows. So what is a strong low? A strong low is a demand zone which led to a break of structure, making a higher high, right? So this is the higher high, and this becomes the higher low. What this indicates is there are more number of buyers and more number of demand that is being created at this particular area. So this is considered as a strong high because it led to the formation of a higher high. So price again comes down, price again takes support, price breaks this structure. So this particular thing, so this particular uh, low will be considered as a higher low, and this is considered as a higher high. Okay, so from this higher low to this higher high, what do we call this thing? So this is nothing but a swing. Okay, okay. So the path from here to here, we call this as a swing. This is the swing high, and this is the swing low. Okay, so we are trying to trade this swing, and what is our job is to identify how this higher low will form in an uptrend, or high the lower low or lower high will form in order to trade that trend. Okay, we need to buy this thing at a very discount price to maintain a minimum amount of risk and a guaranteed profit. Okay, so how are we going to execute these things? This is the entire blueprint of what we are learning, and how these fundamentals or how these financial markets actually work. Okay, so let us see some of the examples for that. So let me go to the 1 day time frame. Okay, let's go somewhere around here. Okay, what do we see? We see an uptrend. Okay, okay. So with the time, the volume is increasing. Okay, with the time, volume is increasing, as so as the price. Okay, so what does it indicate? The market is, first of all, we need to identify the trend. Okay, so the market is in an uptrend. Okay, so that we have confirmed. So what is our job? Our job is to buy this thing as much as possible, avoiding the sell thing, because we are trading against the trend. Okay, so if we trade against the trend, more number of buy. Okay, so if this is the equilibrium, so there are more number of buyers than sellers, right? There are more number of buyers than sellers. So we are few in number, and there are more number of players who are trying to oppose us. So the chances of us getting a profit is comparatively low because there are more number of buyers in the market and we are trying to sell this thing. So this is a very stupid thing to execute because we are trading against the trend. So obviously the chances of our trade getting failed is comparatively more. Okay, yeah. Ay, William Saleh. Okay, so market is currently in an uptrend. Okay, let's imagine we are somewhere around here. Okay, so what I notice is the previously where did the market or where did the gold started to halt. Okay, so this was a particular supply zone. How I am considering this as a supply zone is because price rapidly spiked to the upwards at the rate at which it made this high. In the same rate it came down, which means there are equal number of buyers and equal number of sellers. The people who are trying to buy this thing here, they are selling this thing here. Okay, so the price drastically fell from over here to here. Okay, and when the price came back to fill this particular gap, and since it is an uptrend, the price want the price was wanting to go and make another higher high, but what had happened, the price eventually created a low, indicating that this is a perfect selling opportunity for us. Okay, so price reacted to this zone and price broke this low. So this is a change of character. Okay, so what did I say? When a low fails to do its job, let's say this is the low, this this was trying to form this particular high, but it failed to do its job. So this is a strong high, right? So this is a strong high because there are more number of sellers who are trying to sell this particular thing. And the why I call this thing as a strong low, a strong high is because it did its job. What it did, it broke this particular low. Okay, it broke the low of this thing. Okay, so we have a change of character. So overall trend is bullish, but the intraday trend or the lower time frame trends, short term trends are negative. Okay, so what are we looking for is the maximum amount of possibility that we so if you want to make profit, then I'm going to observe this particular thing. So in the daily time frame, say if you involve the daily time frame and the weekly time frame and the 4 hour time frame, so these are the higher time frames. Okay, the more number of the higher the time frame, the better the confirmations are. Okay, so in the higher time frame, if the price is showing the signs of bearishness, so that indicates that more number of sellers are there in the market, right? So what the confirmation I got is whenever the price comes to this particular thing, I am going to sell this particular thing. Okay, so price created another low, so this we can term it as a lower high because the price is lower from the previous thing and it is a stronger, that is why we call it as a lower high. Price started to show some pullback, but it's failed to do its job. Again it's tried to show some pullback, failed to do its job. So this low was previously broken and closed. Okay, so this is our particular swing high. Continue with this whole zone. Okay, so this is our particular swing high and this is our low. This is another higher low, sorry, lower high. Okay, so this is a lower high. Why it is a lower high? Because it broke the structure. So this is something we call it as a break of structure. Okay, so this is the break of structure, and again the price went all the way back here and then again the price was reacting to this particular zone, and then again the price was shifting here and there. So everything happened, and finally the price broke this particular low, again leading to a break of structure. Okay, so I know whenever the price hits these particular areas, so let us mark this particular thing. So the candle or the price which led to that particular uh, lower low to form. Okay. So this was the area. So now let us mark the lower lows. So these were the lower lows. So this was another lower low. So this was another lower low. Huh. So how we are going to term this as a lower low is because they formed a low and then the price started to retrace back from that particular candle. See, the price came to this area and then they started to react. Okay, so that is not important for us. What is important for us is where are these key areas. Okay, so this was one particular supply zone, and here it was in another supply zone. Here the prices were for the these are the zones which led to that particular crash. Okay, so as you can see, price went all the way back to that zone, retraced back from it. Price went all the way here, it retraced back. Price went all the way here, retraced it because we are at a strong high. This is not the ultimate strong high. This is okay. You can consider this an ultimate strong high, but these strong highs also get shifted down as the price starts to make a lower lows and lower highs. Okay, so what I was saying was these are the reaction points. So whenever the price approaches these strong highs, I'm trying to only sell this particular thing because the short term trend is negative, that we know, that data we have from over here. Okay, so these are the reaction points for the price to react to us. Okay, so the higher the price, the highest, let's follow the hierarchy. Okay, so how do you identify the strength of these particular lower highs or lower lows or whatever this thing can be? So the higher the hierarchy, the more number of confirmations that we have, as you can see over here. Okay, so the highest point or the highest strong high is the ultimate strong high. It's the ultimate supply zone that we are going to have in the particular uh, in that particular instrument. Okay, so this is okay. When so what I said initially, whenever the price approaches this particular level, I am going to sell this particular thing. Okay, okay, now this is, do not consider this as a short, do not consider this as a an uptrend, a short term uptrend, because this has just shown a change of character and now it is in line with the overall trend. But in order, this is just a pullback. Whenever the price, let's say if the price was in a demand zone, okay, and this is somewhat a supply zone. Okay, if the price has started to move towards the supply area and then it started to change a character, then this particular thing, okay, so this particular thing is not called as a downtrend, it is called a pullback. There's a lot of difference between a trend and a pullback. A pullback occurs only at the nearest point to the swings. Okay, swing highs or swing lows. It does not pierces through any one of those things. Okay, so if it is a negative pullback, then when the price eventually makes a downtrend, the price immediately starts to switch bullish, but it doesn't break this particular strong high which is formed. Okay, so here this was just a pullback. I'm going to mark this on a rotated rectangle. Okay, so this was just a pullback. After the pullback, price started to respect this thing again. Okay, price started to fall. Okay, we can call this, we can trade a whole of this, but price suddenly made a V-shaped reversal. What is a V-shaped reversal? We saw it in earlier. Okay, so at the rate which price fell is the same rate the price bounced back, which means that all the sellers were deleted from the market, because the people who are trying to enter this thing in a big money, expecting the price to crash, literally crash, expecting the price to jump, crash from here all the way to here, they were thinking that the price will reach over here. But what did the price do? All the buyers stepped into the market and started to buy this particular thing, which ultimately led all the people to all the people who had sold this particular thing here and all of these zones, they start to exit their market, because they will know the price is no longer interested to go downwards. So ultimately forcing them to exit those trades, pushing the price more higher, and all the buyers are stepping into the market. Okay, so this is how all these fundamental. Okay, so fuck, my mic was mute. I didn't notice it. But yeah, these were the basic of how how the financial markets work. We've seen what is the change of character and a bit of structure, and how these charts form, and what are the strong highs and what are the strong lows. What is the contribution of volume? how does these things form, and why these things form, and what is a trend, and what is a pullback, and what is the supply areas. So let's imagine if we are if the price is something like this. Okay, okay. So price is something like this, and the price is suddenly shift bullish so what is our job is to find out the best amount of confirmations or validations at the particular area. So if let's say if I wanted to trade this pullback, what are the confirmations or what are the validations that I need to see on the charts in order for me to capture this whole of this pullback, or how the price reacts on demand zones, how what price usually does, how does big players enter the market, how do bank trades, how does the big hedge funds trade, all of those things, how does the liquidity works, we are going to cover in the next video.